This silver has good weight. Let me see the mark. The gold is purer.
If you still think gold is only for rich people and silver is just a cheaper version of gold, then after this video, your entire thinking is going to change. Today, we are not talking about prices, we are not making predictions, we are not telling you to buy or sell. Today, we are going deep into the real reason these two metals move, and more importantly, how the human mind reacts when they move. Because markets are not made of numbers. Markets are made of human behavior. Remember this one line forever. Value is not what is inside the thing. Value is what people believe about the thing. Gold and silver run on exactly this belief. Think about it. A piece of gold that came out of a grave 5,000 years ago and a piece of gold that just came out of a refinery today. Both still carry value for the same reason. Because the value of gold is not in its utility. The value comes from the collective trust of millions of people across centuries. Now let me take you back to 1971. Before 1971, most currencies in the world were linked to gold in one way or another. Your paper note actually stood for something real, gold sitting in a vault. Then the system changed. Currencies became pure trust, just pieces of paper that have value only because we all agreed they have value. As long as the system stays stable, this trust works. But the moment uncertainty appears, the moment rules start changing, the moment the future becomes unclear, human trust starts shaking. And when trust shakes, money doesn't run away. It hides. Gold does not chase profits. Gold is the place where scared money goes to hide. When the world's biggest currency system feels strong, people take risks. Stocks rise, businesses grow, real estate booms. But the moment that same system starts looking weak or the future starts feeling unpredictable, investor behavior completely flips. They ask one simple question. If the whole system fails, what will still be left? That is exactly when demand for gold explodes. That is why the dollar and gold almost always move in opposite directions. Dollar weak, gold strong. Dollar strong, gold under pressure. This is not a conspiracy. This is pure human psychology. Now let's understand fear. Fear is not new. Humans have been making decisions out of fear for thousands of years. When our brain feels the future is unsafe, it does two things. It runs away from risk and it runs toward familiarity. Stock markets feel unfamiliar in crisis. Derivatives feel unfamiliar. Complex financial products feel unfamiliar. But gold? Gold feels familiar. Gold has been money for 5,000 years. That is why in every single crisis you see the same pattern. Risk assets fall. Safe, familiar assets rise. Crises don't create demand. Crises only reveal the demand that was already hiding inside people's hearts. Now let's talk about interest rates, because this is where most people get confused. Gold does not compete with other metals. Gold competes with interest rates. When banks and bonds are giving you good fixed returns, gold feels boring because gold pays zero interest. But when those fixed returns become small, when inflation starts eating the interest, gold suddenly starts looking very attractive. This is not magic. This is simply the game of opportunity cost. Now let's come to silver, because this is where the biggest misunderstandings happen. Silver is not only a store of value. Silver is also an industrial metal. That means silver does not only react to fear, it also reacts to economic growth. Electronics, solar panels, electric vehicles, medical equipment, all of these need silver. And there is another problem with silver. Its supply cannot be increased quickly. Most silver comes as a byproduct of other metals. You cannot just open new mines only for silver. So when demand suddenly rises, supply cannot respond immediately. That is why silver is far more volatile than gold. It rises faster than gold in good times and falls faster in bad times. Gold is the thermometer of trust. Silver is the heartbeat of the economy. When markets panic, both go up. But when the economy is expanding and industry is growing, silver often leaves gold behind. One last important thing. Trading and investing are not the same thing. Trading is about timing. Investing is about positioning. In the short term, gold and silver can look confusing. In the long term, they are the shock absorbers of your portfolio. You don't keep them to become rich overnight. You keep them so that when the system shakes, your entire portfolio does not break. Final thought. Gold and silver prices do not follow headlines. Gold and silver follow reasons. Once you understand when trust is built,
when fear gets activated, what role interest rates play, and how industrial demand works, gold and silver will never confuse you again. Markets do not run on rumors. Markets run on human logic. If you now see gold and silver not just as numbers, but as mirrors of human behavior, then do one thing for me. Hit that like button and drop a comment. What is your biggest question about gold or silver right now? I read every single comment and I will answer the best ones in the next video. Until next time, stay calm, stay prepared, and remember, in the end, it's not the metal that has value, it's the belief we all put in it.
Thank you for watching.